Namaste and welcome to VD Decode YouTube channel.
Okay, let's just get right into this. Welcome to this explainer, where we are absolutely going to transform the way you look at the financial markets. If you are an absolute beginner starting your trading or investing journey, staring at a screen full of flashing numbers and jagged lines can honestly feel like trying to read a foreign language in the dark. It's overwhelming, right? But today, we are turning on the lights. We're going to walk through the ultimate cinematic guide to decoding the stock market using TradingView. By the time we wrap up this explainer, those intimidating charts are going to look like clear, perfectly readable maps.
Think about it for a second. When you look at a live market chart, have you ever actually stopped and wondered, how do you read the emotions of millions of traders on a single screen? It sounds literally impossible, right? Tracking the panic, the greed, the excitement of millions of people all at once. But here's the secret. There is actually a clear visual language that reveals their exact intentions. You see, individual retail traders like you and me, we don't manipulate the markets. The big players do, the massive foreign and domestic institutional investors. And the beautiful thing is, they always leave footprints.
And this brings us to an absolutely crucial point to understand right from the start. Price charts, they aren't just cold math or random algorithms. They are pure human psychology playing out in real time. Candlestick patterns are literally visual representations of the market's emotions. They reflect fear, greed, and indecision. Every single tick captures this massive, ongoing battle between buyers and sellers, telling you exactly who is taking control of the market at any given millisecond.
To decode this language, this explainer draws straight from the premium Legacy Wealth Builder framework. Today, we're taking these high-level inner circle concepts from our source material and breaking them all down to turn those intimidating charts into actionable, beginner-friendly insights. We're going to completely strip away the noise and focus purely on the core principles of price action and technical analysis that actually work in the real world.
All right, let's start with the basic building block, the OHLCV. This simply stands for open, high, low, close, and volume. Every single candlestick you see on your screen is built on this exact foundation. You see the thick part? We call that the body, and it shows you exactly where the price opened and closed during a specific time frame. And those thin lines sticking out of the top and bottom, those are the wicks, or shadows. They show you the extreme highs and extreme lows reached during that period. Basically, if a candle is green, the price closed higher than it opened. That's a bullish move. If it's red, it closed lower, a bearish move. Now, let's group these individual blocks into words by looking at single patterns. On one end of the spectrum, we have the Marubozu, which translates to bald candle, because it has minimal or no wicks. A massive green Marubozu means buyers were in absolute total control from the opening bell right to the closing bell. It's a sign of huge directional momentum. But on the exact opposite end, you have the Doji. This is where the opening and closing prices are almost identical, leaving a candle with basically no body. A doji is a perfect tie in our tug-of-war. It's pure market indecision, where neither the buyers nor the sellers could gain the upper hand. And this brilliant dynamic creates a constant battlefield right on your screen. You see, trading is just an eternal battle of aggression. Buyer aggression creates demand, and that pushes prices up to form those solid green candles. Seller aggression creates supply, dragging prices down to create the red ones. So whenever you look at a chart, I don't want you to just see colors anymore. I want you to ask yourself, right now, who was more aggressive during this time period, the buyers or the sellers? When we start combining these single candles into double or triple patterns, that's where the real stories unfold. Take the Harami pattern, for example. In Japanese, Harami actually means pregnant woman. It's formed by a large candle followed by a smaller one tucked entirely inside its body. So, if you spot a massive red candle with a tiny green one in its belly, that's a huge signal. Buyers are absorbing the selling pressure, and a reversal might be coming. Or look at the engulfing pattern, where one massive candle just completely swallows the previous one, showing a violent shift in power. And then you've got triple patterns, like the morning star, a sequence that beautifully signals the end of a dark, bearish night and the sunrise of a brand new bullish trend.
Okay, now that we've got the micro movements down, let's zoom out to the macro level. How do these candlestick patterns react against the market's key invisible barriers? We call these support and resistance. Think of support as a floor, a price level where buying interest is just so strong it stops the price from dropping any further. The market repeatedly bounces right off this zone. Resistance is your ceiling, where selling pressure stops the price from advancing. And here's a pro tip for you. These aren't exact, perfectly drawn lines. They are zones, usually with about a 1% buffer. And get this, when a price finally smashes through a resistance ceiling, that old ceiling, it very often becomes the new support floor.
But sometimes, the market just skips these zones entirely overnight. Markets close at 3:30 p.m., sure, but global news, that runs 24/7. Earnings reports or geopolitical events can cause the opening price the next day to differ wildly from the previous close, creating what we call a gap. Now, not all gaps are created equal. Common gaps happen in sideways markets, and they're just noise. Think of them like pesky mosquitoes. But breakaway gaps? Those are completely different. They happen when the price violently breaks out of a consolidation zone with huge volume, and they can ignite massive, highly profitable new trends.
So how do we organize and process all this visual data without losing our minds? We turn to TradingView. It's a highly intuitive, completely free platform you can access right from your browser. This is your modern finance dashboard. Here, you can clean up all the chart clutter, tweak your pivot point colors, and load up your essential technical indicators. We're talking about tools like the RSI for momentum, the MACD, Fibonacci retracements, and the ATR to measure market volatility.
And here is where it gets really powerful for beginners. You don't actually have to memorize every single candlestick pattern we just talked about. You can just leverage automation. TradingView has this amazing feature called the Pine Editor right at the bottom of the screen. By just following a few simple steps, copying custom pattern recognition code, clicking Create New Indicator, pasting it in, and adding it to your chart, the software will automatically scan the market and literally label the Dojis, the Marubozus, and the engulfing patterns directly on your screen across any time frame.
Once your chart is all set up, you'll want to track the overarching momentum using moving averages. But you've got a choice to make here. The simple moving average, or SMA, gives equal weight to all prices. It's fantastic for smoothing out all the daily noise so you can see the broad, overarching trend. However, if you're trading where speed really matters, you want the exponential moving average, or EMA. The EMA reacts much faster because it heavily weights recent price changes, getting you in and out of trends earlier. Just a heads up, though, that speed can sometimes produce a few more false signals.
While you're tracking trends with tools like the RSI or MACD, you absolutely need to watch out for something called divergence. This happens when the stock price is pushing to higher highs, but your momentum indicator is making lower highs. Actually, let me clarify something really important here. Divergence is not a signal for a complete trend reversal. Don't think of it as a full U-turn. Think of it more like a speed breaker on the highway. It's a warning sign telling you momentum is slowing down and a little pullback or a bounce is probably coming.
All right, so you understand the visual language of candlesticks, you know how to map support and resistance, and your TradingView dashboard is fully automated and ready to go. Are we ready to trade? Hold on. Before you risk a single rupee, we must establish strict rules of engagement. Moving from theory to actual trading requires a rock-solid, universal strategy framework. Without this framework, you aren't trading. You are literally just guessing in the dark.
Because the absolute core of any professional framework is discipline. Every single strategy, no matter how incredibly complex it is, requires 3 non-negotiable elements. Number 1, your entry price, the exact trigger point where you get in. Number 2, your stop loss, the absolute maximum acceptable loss where you admit you are wrong and exit to protect your account. And number 3, your target, your predefined profit-taking level. If you jump into the market without knowing all 3 of these numbers in advance, well, that's just gambling. And how exactly do you determine that target? The ultimate golden rule for protecting your capital and ensuring your long-term survival is a mandatory 1-to-2 risk-reward ratio. This is the simple math of trading success. It means that if your stop loss says you're risking a loss of 10 points, your profit target absolutely must be set to gain a minimum of 20 points. By enforcing this ratio, you could literally be wrong on more than half of your trades and still come out profitable over time. It's basically magic.
To make sure you actually survive this beginner learning phase, you have got to follow strict risk management rules. First, start incredibly small. Begin with just 1,000 rupees, trading maybe 1 or 2 shares, just to build your confidence and test your execution before you ever think about scaling up. Second, enforce ironclad exit discipline. When the price hits your target, take the profit. And finally, stick exclusively to the daily time frame at the beginning. 1 candle equals 1 day. Lower time frames like 1-minute or 3-minute charts, they are just full of erratic market noise that will chop a beginner's account to pieces. The daily chart gives you clean, reliable signals. So, look at that. The financial charts are no longer a total mystery, are they? They are speaking to you every single day, reflecting the fear, the greed, and the massive ongoing battles of millions of participants. With a clean TradingView setup, a solid grasp of price action, and ironclad risk management, the power is literally right in your hands. So, I leave you with this final thought. Are you going to use these tools to master the emotions of the market, or will you just jump in blindly and let the market's emotions master you? The choice and the chart is yours to decode.